And joining us now to talk about the markets is Jason Pride. He's the Director of Investment Strategy for Glenmede. Jason, thanks for spending some time with us here on In the Loop. Tell me what you think these days about equities versus fixed income. Which offers the better value?
Look, this is a difficult call right now. As far as long-term value is concerned, equity valuations are very attractive and fixed income valuations are very expensive. But what we have hanging over us is a significant amount of uncertainty. You know, a lot of people are worried about us going into another recession. I still think that that is going to be, if it occurs, it's going to be more mild than anything under majority of the circumstances. The two things that are really bothering people is there's kind of a breakdown of confidence surrounding the debt situation and a true systemic risk in Europe. And when you have those two things on the table, you have to take a more protective approach than if you were to just look at valuations on the whole. We're favoring equities, but we're staying defensive kind of in our posturing by staying in the middle of the risk spectrum.
So, Jason, most people would think that value stocks offer better protection in the context you just provided, but you say growth has actually been outperforming.
Yeah, I think that occurs quite often when you have something that's more systemic in nature that comes about quickly. Basically, when you're looking at growth stocks, typically those indexes tend to include higher quality stocks than the value indexes. The environment that we've been coming through actually had a situation where valuation and growth spreads, the differences in their valuations actually compressed a good bit. That undermines the protective ability of valuation by itself. And the fact that higher quality companies are in the growth indexes makes their business models more protective in this environment. So they have outperformed due to concerns of a systemic shock coming from Europe and just an overall recession.
Jason, number of analysts still looking for the S&P to be around 1,400 by the end of the year. You think that's overly optimistic?
We're in a situation of fairly digital outcomes. So if you don't have a European systemic event, if somehow they stave this off or manage to kick the can a little bit further, or even, hey, you know, we may actually have one of those situations where they put in the right long-term plan. I still kind of question that a little bit. If any of those situations come out, those sort of projections are not out of the realm of possibilities. However, there's this risk, and it's a larger risk than normal, that you have some sort of systemic event happen before the policymakers actually react. And that's why the markets are hanging out where they're hanging out today. And you know, if that occurs, it's going to be a downward leg from here for the markets. So we're trying to protect against that while still capturing that long-term return.
How much of a downward leg do you think is possible?
You know, that's fairly unmeasurable. You know, you can put numbers on it anywhere from just another 5%, depending on how quickly the policymakers then react afterwards, to something as large as 20% in the U.S. markets, which would get down to the levels on an absolute valuation that we saw basically back in '09. I kind of question if it's going to be that much of a downside, but there's always the possibility of it, and you have to protect against those systemic events to some degree or another in these situations.
So, Jason, quickly, I'm sure you have a lot of clients asking you, do they buy now or do they wait for another downward leg? What's your recommendation?
So our recommendation is we've been getting defensive, or we have been defensive. We got a little bit more defensive, basically because you have a lot of these items that are going to be coming out over the next 2 to 3 months that will define whether we're going into more of a difficult period or whether they're actually going to put in place the right policies to protect investors. Our recommendation at this point in time, since you're already defensive, is take a bit of a wait-and-see approach. Start averaging in slowly at this point, but do it on indications that either the economy is stabilizing, that policymakers are starting to make the right decisions, or that the systemic risk in Europe is beginning to fade. Unfortunately, we've seen very little of those indications at this point in time, so we're taking a fairly cautious wait-and-see approach.
All right, Jason, thanks so much for joining us.